This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my market insights for Tuesday, February 12th. Well, actually, it's a little late to be commenting on this as it happened last Friday while I was on a business trip, but I'd just like to say a few words about the Bank of Japan's move to institute negative interest rates. This is exactly what I thought they'd do eventually, although I admit I didn't expect them to do it at this meeting. There are several significant points from the Bank of Japan's move. First, it validates negative interest rates as a major central bank tool. Before, the European Central Bank was the only major central bank doing this. The others were Denmark, Sweden, and Switzerland, some small countries. Now, with two of the big central banks adopting this policy, it becomes standard practice. That could encourage the ECB to cut rates further and weaken the euro. It's already affected views on rates in the UK, where the probability of a cut in rates by the end of this year jumped to 32% from 10% before the announcement. It's since fallen back to 18%. The Bank of Japan said, quote, "It will cut the interest rate further into negative territory if judged as necessary," unquote. That means we're probably in for further cuts in Japan, which means, in effect, a currency war, as other central banks follow its lead and cut further and further, one after the other. The Bank of Japan is specifically targeting market rates. It said it would, quote, "lower the short end of the yield curve," unquote, and, quote, "exert further downward pressure on interest rates across the entire yield curve," unquote. Moreover, unlike the ECB, it, quote, "will not set a lower bound for yields on its JGB purchases," unquote. This is a powerful way in which the move is likely to be transmitted to the currency markets. Here are some graphs of the real interest rate spread, that is, the spread between Japanese and US or Japanese and European rates after taking inflation into account, and dollar-yen on the one hand and euro-yen on the other hand. As you can see, the currency pairs are indeed sensitive to the real interest rate spread. So, as the spread on nominal yields widens and one assumes Japanese inflation picks up, then the dollar and the euro should both, in theory, gain against the yen. The move will probably not help Japanese companies that much, as rates on Japanese corporate bonds were already so low. And the Bank of Japan is already buying their bonds from the secondary market at negative yields anyway. This implies that the move was aimed at pushing the yen down and thereby pushing inflation expectations up. I wonder if the ECB will follow Japan's lead and abandon its policy of not buying bonds at yields lower than its deposit rate. That would really open the way to a currency war. In sum, I think the move was a powerful statement both for Japan and for global central bank monetary policy in general. I expect the yen to depreciate further as a result. I also think it opens the way for other central banks that have instituted negative rates, such as the ECB and the Swiss National Bank, to cut rates further, thereby depressing those currencies too. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.